Okay, folks, welcome back. This is the ICT Mentorship 50 to 75 pips per week model, price action model number 9, one shot, one kill. I appreciate your patience. I was trying to get a setup for this model on the Monday, week ending December 4th, 2020, but it required me to get it on Tuesday. So we're looking at an example inside of this trade plan. Usually I prompt you to look for your own, which you'll still be prompted to look for your own with this one, but I included a real world example and execution you can find on my YouTube channel. Okay, ICT price action model number 9, 50 to 75 pips per week trade plan, one shot, one kill model. Like always, there's 5 stages to every trade plan development. First, preparation, opportunity discovery, trade planning, trade execution, and trade management. All right, so preparation. Obviously, we're going to be noting all medium and high impact events for the markets that you're going to be following. You're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Now, just a slight twist here on IPTA. Okay, I'm bringing in the weekly chart. So in this case, we're looking at the preparation stage, and we're going to be determining the IPTA data range of the last 20 weeks. So we're replacing days with weeks. Note the highest high and the lowest low in the past 20 weeks. This is your current dealing range. Now we're looking at a intermediate term time horizon. So it's going to give us a lot more predictive nature to where price is going to draw on an institutional level, not intraday, but on a larger macro scale. So we're going to be looking at 20 weeks ago, and in the highest high and the lowest low of that range is going to be salient for this model. Inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? Below which old low, above which old high? We look for a PD array in the direction of the weekly range bias. Now, you have the benefit of having the archives and my commentaries, and you'll see that we were looking for bullish euro dollar, bearish dollar at the time of this trade plan's presentation. So it's not like I'm cherry picking. I'm not trying to talk about something in conceptual form only, and using hindsight, I actually used this model for an example and shared it with the public on YouTube. We anticipate price to move to a PD array that would support our weekly bias on a day and news release found on the economic calendar for the current or next trading week. This volatility injection is what we wait for. This would be a run based on a low resistance liquidity run condition. Opportunity discovery. Now in this chart here, I'm showing you 2 ranges or 2 rectangles. And when I look at one shot, one kill, my preference is 50 to 75 pips. Now, I'm not trying to get my full entry to exit at 75 maximum pips. It's not what I try to do, but you can graduate to that if you want that to be your model. But I like to look for easy 50 pips. So half a penny move is basically my one shot, one kill. So we're going to be looking for price action with that range in mind, 50 to 75 pips. And we look at how the swings outline where potential runs on old highs and old lows would frame 50 to 75 pips. So we look for 50 to 75 pips that would enable a run to buy side liquidity when bullish institutional order flow is present, or target the sell side liquidity when the bearish institutional order flow is present. Trade planning. When the market is poised to decline, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection would likely unfold. We will short premium buy-side liquidity pools. When the market is poised to rally, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will buy discount sell-side liquidity pools. trade executions. When we are bearish, we will anticipate a 15-minute chart optimal trade entry to form inside of a retracement higher during London Open and or New York Open kill zones, or a buy stop raid that we will go short when it unfolds. When we are bullish, we will anticipate a 15-minute chart optimal trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid that we will go long when it unfolds. Short trade management. When we are entering a short, we will short at the market with our demo account. We will use the PD array convergence optimal trade entry inside of a kill zone as our entry price when using the short market order. When we are entering a long, we will buy at the market with our demo account. We will use the PD array convergence optimal trade entry inside of a kill zone as our entry price when using the buy market order. When we are entering a short, we will place a limit order to take 50 pips as our objective on a single position. Or, as an alternative, we will use one order to manage the trade idea. If you capture a 50 pip objective, close 80% of the position and see if the remainder can reach 75 pips, taking partials along the way at logical short-term lows. When we're entering a long, we will place a limit order to take 50 pips as our objective on one single position. Or alternatively, we will use one order to manage the trade idea. If you capture a 50 pip objective, close 80% of the position and see if the remainder can reach 75 pips. Again, taking partials at short-term highs along the way. Stop loss management. When we are in profit 50% of our expected objective, stop loss can be reduced by 25%. When we are in profit 75% of our expected objective, stop loss can be reduced by break even. In the example on my YouTube channel, you actually see me utilize this method. Money management. Position size calculation formula. Position size equals account equity times R% divided by stop loss in pips. Position size is the amount of leverage your trade or trades assume. Account equity is the total amount in your trading account. R% is the percent of risk you're willing to take on per trade. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R%. Example, account equity of $10,000. Risk per trade is 1%, or 10,000 times 1% equals $100. So the stop required for the trade is 20 pips. In micro lots, or 1K in leverage, each represents 10 cents per pip. So if we're using 20 pips on a stop, 10 cents into 20 pips is $2 per pip. $100 divided by $2 per pip allows us to trade with 50 micro lots per trade, or 1% of the account equity. Always round down. In this example here, we're utilizing mini lots, same representation of an account hypothetically at $10,000, 1% risk is $100. Stop required, 20 pips. So in mini lots, 10K each leverage represents $1 per pip. So if we're using a trade with a 20 pip stop loss at $1 per mini lot, it represents a dollar cost of $20 USD. So we have a total risk of $100 that we're allowed to assume. With $20 divided into that 100, it allows us to have 5 mini lots per trade, or 1% of the account equity. Always round down. And again, same instance with hypothetical $10,000 account, 1% risk is $100, and you cannot utilize this framework with a standard lot because it's too much leverage. If your demo account takes a loss on a trade and it is the full R% you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. In this example, say you took the full loss of $100. The next trade, you have to use leverage that allows you to only risk $50. If that trade allows you to make $25 back, that will allow you to go back to that full $100 risk. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R percent by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not jagged with deep declines. Real-time example. All right, let's look at the Eurodollar and a real execution on this model with the week ending December 4th, 2020. Now, again, I'm counseling you to go back into the archives in my commentary section and look at our analysis as we were looking for higher objectives on this pair and lower on the dollar. So the conditions were bullish Eurodollar, and our commentary suggested price could reach up to a fair value gap in higher time frame charts. Now the chart to the left here, let's zoom in on that. This is actually a weekly chart. You can see the fair value gap and the 20-week old high that's being referenced there. So that old high we're going to anticipate, and you can see here with the benefit of hindsight now, but I want you to remember that this was outlined in commentary in terms of bias, where I was suggesting you turn your attention to for Eurodollar. It was bullish. So this is the, at present, on the 2nd of December 2020 at the time of this recording. So we're seeing what the weekly range looks at the moment. It might change, it might expand even more. It doesn't matter. All we're doing is looking for this weekly range to expand. Okay? If that expands, it gives us probability that our bullishness on intraday charts or short-term trading should allow us the ability to find and harvest a setup that is bullish. So we're looking for a run above that 20-week old high for buy-side liquidity. So we have bullish bias on the weekly range expansion, so we're expecting that. And now we have to look at the economic calendar. So we're going to look inside this area of price action, and we're going to go down to a daily chart. So it just so happens on Tuesday, December 1st, 2020, bullish range expansion anticipated. The economic calendar suggested that we would have a high impact news event with the Fed chair speaking at 10 a.m. New York local time. This is what the chart looked like on a individual daily basis. So the next candle, I'm forecasting a run higher. So I'm looking for what? A day trade. And I'm looking for the likelihood of 50 to 75 pips using the low end 50 pips. So on December 1st, you can see here, Tuesday, December 1st, the market creates a impulse leg higher, and then it retraces. It creates an optimal trade entry going into the New York session. So during New York Open, we have the Fibonacci laid over top of the bodies of the candles. So that gives us a more precise area of entry. You can look at the recording that's on my YouTube channel, and I actually go over the entries and such. You can see me executing, and you can see the actual prices. So that's not important for this example because you can actually watch me trade, enter it, manage to stop the whole business, and it's my limit order. The projections on the fib obviously can be forecasted to the tune of 50 pips or 75 pips, but because I just want certain amounts of the content that I have as education only making its way to YouTube, I used the lower threshold, and I didn't do a whole lot of annotations in the chart. I just made it very simple with optimal trade entry, which is what we're using here because that was the model I used in real time on the 1st of December. So the market allows me to get 50 pips, and I took scaled out logical exits as the market made higher runs above premium arrays. So going back to this range here, this is what it looked like on the daily, and then ultimately we had that explosion here on Eurodollar. Now in the video, obviously I'm holding back what would draw attention to these PD arrays. I just used a very short-term swing high in drawing buy-side liquidity in reference to that. But using this model here, it allows for a lot larger magnitude in terms of scaled out profits, or ultimately maybe even more than 75 pips for one shot, one kill. Start back testing. Collect multiple sample sets with your trade plan. If you're unclear about some of the process, rewatch the lessons in this price action model. I will provide more sample sets, but do not rely on or wait for mine. Dig into your charts and study what is provided here. Good luck.